Good morning, everyone, and welcome to this, the third in our series of Now is the Time for Alternatives. Just to recap on this series and why we're having it, we think that we're entering into a very different environment for investors. Over the past 40 years, most of our investment lifetime, we've been in a period where interest rates have been falling, which have provided tailwind for bonds. Bonds have therefore become a very integral part of most people's portfolios as both a hedge to equity exposure, and they've been an excellent hedge, but also have delivered a very strong return over that 40-year period. While we think bonds may still behave as a hedge for equities, we don't think that they're going to provide a reasonable return. And therefore, investors are looking for alternative ways of generating reasonable returns whilst managing their risk. And they are turning to alternative strategies to try and achieve these outcomes. Today we have with us Rob Saunders and Ben McCallum from Regal Asset Management, an Australian boutique manager who specialises in a broad range of alternative strategies. The strategy we're going to hone in on this morning is called the Regal Emerging Companies Strategy. And as the name suggests, this strategy focuses on emerging companies. That is not new companies, or it's not private equity or VC, it's emerging onto the stock exchange. So companies that have been successful enough to be able to come to public markets for capital. So this is, in Australia, the IPO, initial public offering market, is an extremely dynamic market, unlike New Zealand where it virtually doesn't exist anymore. In Australia this year, 2020, which has not been a great year for IPOs because of the disruptions of COVID to the market, there have been 23 IPOs in Australia, and the average return on those has been 54%. In 2019, there were 64 IPOs in Australia, and the average return as of today is 60% on those 64 IPOs. So while it is a dynamic market and a very active market, it's a very difficult market for particularly New Zealand investors to access. And even more so the pre-IPO market. Regal is the preeminent player in this space in Australia. And when they approached me in 2016 with an offering of a pre-IPO fund that accesses this market, we were immediately interested in this product. And we think that it's a great idea for New Zealand investors. This is a wholesale offering, and it is even for wholesale investors, even very large investors, this is a very difficult market for them to access, particularly at the level that Regal is able to access this market. So it's a great pleasure, as I've said, to have Rob and Ben with us today. Just before I hand over to Rob, there is a Q&A button on your screen, and we welcome your questions. We're the only ones that can see them, so not everyone will be able to see them. So please feel free to ask questions, and we'll do our best to answer those for you as we go. I will keep an eye out for those, and I'll try and interrupt Rob and Ben at a timely part throughout this presentation. So Rob, I'll hand over to you, and Ben, and thanks very much.
Thanks, Mark. Thanks for the introduction. Good morning, everyone. I hope all well, wherever you're zooming in from. I hope you and your families are all safe and healthy. Thanks very much for the introduction, Mark, and obviously for the support from Sachs Coburg. We very much appreciate it. What I might do here is I'll just share my screen so we can get a presentation deck up in front of everyone. So just stand by for one moment and we'll do that. Perhaps, Mark, you could give me the thumbs up if that's coming through okay. Lovely. Terrific. As Mark said, my name's Rob Saunders. I look after our partnerships and relationships with our wholesale investors and family offices at Regal Funds Management. Joining me today is Ben McCallum, who's one of our senior portfolio managers in our emerging companies strategy. For those that aren't familiar with Regal, we're a specialist alternative investments manager. The business was founded in 2004. We're in our 16th year since inception. We currently manage about $2 billion across a variety of strategies on behalf of wholesale investors. So predominantly institutional investors, family offices, charities, endowments, and private investors. As a team, we've got probably one of the larger fundamental teams in Australia, certainly across alternative equity managers. We've got 19 staff that contribute to the strategies across portfolio managers, analysts, and sector specialists, which gives us a fantastic breadth of ideas, idea generation, and obviously contacts across the markets. The business is 100% privately owned, with key staff all retaining an equity interest in the business. I think above all, something that we always like to talk to clients and investors about is we always aim to be the benchmark in alignment in terms of investing our own capital in the funds. And of the $2 billion that we manage, just over a third of that represents the personal investments of founders and staff of the business. As I said, across the wholesale funds that we manage, they sit across 6 core strategies. Those strategies range across the capital structure and market caps and geographies, from pre-IPO and emerging companies, which we're going to talk about today, through to Australian small companies, more traditional long-short strategies, and then larger cap absolute return strategies. In addition to the wholesale direct funds that we manage, we've also got an ASX listed investment trust called the Regal Investment Fund, which trades on the ASX. And we also retain a 50% ownership in a rural farmlands and water business, Kilter Rural, which manages 600 million odd for institutional investors in that space. As Mark said, we're talking today about our emerging companies strategy. Regal's got a long history of investing and supporting businesses in that pre-IPO emerging company space. In 2016, the business made the decision to launch a dedicated strategy to allow investors to access that market. And as Mark said, it's a market that traditionally is very difficult to access on a direct basis. Pleasingly, the returns have been very good for the strategy, and subsequent funds that we've launched have been well supported by our investor base. So we manage approximately $600 million across the strategy in totality now. At the moment, that's managed across 3 closed-ended funds. So they're funds that have a fixed investment term. That's funds 1, 2, and 3. Investors ultimately were asked to provide capital on a 5-year basis. We would invest that for 3 years and then spend 2 years returning that capital, and hopefully the returns of those investments over time. So Fund 1 was launched in 2016. It's delivered 77% since its inception. It's now in its harvest stage, so it's returning capital back to those investors. Fund 2 was launched in April 2018. It's delivered 50%, and Fund 3 in August 2019, which pleasingly has delivered over 120% for investors. And then more recently, we launched the Regal Emerging Companies Opportunities Fund, which is our 4th and final fund. That's an open-ended fund rather than a closed-ended fund, which means that investors can continue to invest in the structure, subject to available capacity. And also allows investors to pull their capital out should they so choose on a twice annual basis. We launched that a couple of months ago with the aim of sort of raising around about $100 million. Pleasingly, that came in about a month. So that's now soft closed at the moment, but if there are opportunities in the future, we'll certainly provide that to investors. The strategy itself has 3 dedicated portfolio managers. Ben, who's on the call, Jessica Farr-James, and the Regal CIO, Phil King, also provides direct stock inputs into the strategy. And again, like the rest of the business, about 30% of the capital that we manage represents internal funds. I'll just pass it over to Ben now, who's going to run through the strategy and try and provide a little bit of colour around specifically what the opportunity set is inside that pre-IPO space, why we feel like we've got an edge in accessing it, and how we manage portfolios in that regard. And then maybe talk about some ideas that he's looking at the moment. Just for some background, Ben joined us in 2015. Previously, he worked in private equity, venture capital with Mark Carnegie. And previously at Macquarie Capital to that. So it's we're delighted to be involved today. We'll try and keep it as open as we can. Please ask questions as you like. And with that, I'll pass it over to Ben.
Thanks, Rob, and thanks everybody for your time, and thanks, Mark, for your ongoing support for Regal as a whole, but our strategy in particular. To give everybody a bit of an understanding of the different types of investments we make, they're basically split into three different silos or buckets. The first is listed microcap. So that's in companies that have a market capitalization of $300 million or less. So we typically get access to these businesses via an IPO, a placement of an existing listed company, or in some cases, there's a block trade where an existing shareholder is selling down a position in that company. Sometimes these stocks can be quite illiquid. The liquidity has improved a lot, which I'll talk to later on over the course of the last 6 to 12 months, particularly in the microcap space as more people search for growth. But what we like to do is, build a decent position or get access to a decent position via an IPO placement or block, because we typically pick them up at a discount to where the market is trading. And we don't have much impact on the price to get that position. So that's the first, and probably for the emerging companies opportunities fund, that's where a large portion of the focus is. The second largest investment category is what we call the pre-IPO investments. So these are businesses that are on a very clear path to listing within a 12-month time frame. In a lot of cases, these businesses will come to us via one of the investment banks or broker networks that we have, who are already engaged in an IPO process that might be taking place in 6 to 12 months. But the company just needs some pre-IPO capital to, in a lot of cases, fund an acquisition that they want to bed down into their business and bulk up the business before they come to IPO and extract the synergies and so on. In some cases, it's repaying some expensive debt to clean the balance sheet before coming to IPO. And in a lot of cases, particularly those in the technology space, it's actually just to fund the business over a period of time to get to the IPO. So there's, a lot of these fast growth technology stocks who are still losing money at the time that we invest, but are looking to get to almost cash flow break even or there or thereabouts at the time of the IPO. It's funding that business to get to that point, and there might be some key catalyst events that the business wants to get through before they get to the listing. And then the last category is what we call expansion capital. So these are businesses that are unlisted. They may not necessarily be looking to IPO within a 12-month time frame, but they're stories that we really like. We understand the large addressable market and the position that business has, and we'll have a seat at the table and be happy to take a little bit more unlisted duration risk on those opportunities. Over time, I guess our focus has definitely shifted towards where Regal's got its competitive strength, which is in the listed microcaps and the pre-IPO space, just given the sheer weight of deal flow that Regal actually sees. This slide just gives a bit of an overview of the type of businesses that we're playing in. As Mark alluded to earlier, we're not investing in what we call seed or Series A type investments, so very early stage businesses where they're just a concept or they even have very minimal revenue. We're looking to invest in businesses that have got, almost as a minimum 10, but preferably 20, 30, $40 million of revenue, but also growing at a fast pace. And these businesses just need capital to continue to grow. And in a lot of cases, we're not playing in the private equity style model where, you're essentially buying the entire company or, 50% plus of the business. And you're on the board and you're heavily involved. We're typically giving a group of companies capital that they need that capital to keep growing, and they're on path to an ASX listing most typically, and there's benefits for them to come to the ASX, whether it be through liquidity or Also, a lot of companies like to become a listed company because it helps them actually close contracts as well. In a lot of cases, they might be dealing with blue chip customers who, these blue chips sometimes, want to make sure that the software businesses or the businesses they're interacting with are credible and have a strong balance sheet. And being a listed company obviously gives them that credibility. One of the interesting parts about this sector as well, it's a very collegiate space from on the investors side. In private equity and also in venture capital, they can be quite competitive. Private equity in particular, where an asset might come up for sale, you've got 3 or 4 private equity funds all bidding on that one asset. One of those funds is going to win, and the other 3 have to walk away, and they don't get a piece of it. In our part of the market, we actually like having other co-investors alongside of us, and the reason for that is a couple of points, but the most important one is when these companies come to IPO, it's good to have more fund managers actually in this stock. It helps the IPO process. It essentially underwrites the IPO process for the company. That's why the companies really like it as well. And it also means that, we typically don't miss out on any opportunity. So, in private equity, if you miss out on the deal that is the best deal of that, 1 or 2 year period, then you just miss out. Whereas, we typically get the opportunity to invest in every single pre-IPO company that comes across the space. This slide gives a bit of an overview of a few of the names of the businesses that that are in our portfolio that we've made pre-IPO investments in. And I'll go to them in a minute. I think the important thing to note is that the pre-IPO, when we first launched this strategy 5 years ago, and we were probably the first fund to launch a designated fund for this space. It was still pretty immature, but in the 5 years since then, the pre-IPO space has become a very well-known institutional grade pool of capital that companies can come and source from. And given a lot of the examples that are on this page, plus some others, companies are seeing the benefits of going down this path as opposed to going down the private equity path or staying private for longer, and the benefits that they get from that. So, the deal flow that I saw, 5 years ago was pretty strong, but it has grown exponentially over these last 5 years as that pool of capital has increased. One of the important parts on this as well, and the reason we love this space, is not only do we do quite a bit of diligence before we make the pre-IPO investment, but we get to really know these businesses for the 6 to 12 months leading into the IPO. So instead of a lot of the other institutions on the street, come time for the IPO, they have the 2-3 week scramble to try and learn as much as they possibly can about the company before they potentially put a bid in for the IPO process. We already know these businesses intimately. We've got an exceptionally strong relationship with the management team. We're typically helping them through the IPO process in terms of educating them on how the market will look at their business, the specific metrics that they probably should be focused on, and just the key points. And so, we hold their hand through that process. It means we've just got a significant edge. We as Regal expect to get the best allocation from the street on any deal that comes across the table. But in these deals where we're already pre-IPO investors, it's essentially a guarantee that that we'll get the best allocation in the good deals that are coming through the pipeline as well. I've got a few names here. I'll talk to a few of these just so people have got a bit of a flavour about the type of businesses that we're investing in. A few of these are listed on the ASX, and a couple of them have actually been acquired since we've made the investment. So Damstra is a company that operates in the workplace safety sector. It's a software and hardware business, but the vast majority of their revenue is recurring, and it's tied to the software platform. So their large customers are things like companies like civil construction businesses and mining sites. So anywhere where you have a workforce that's logging into a particular location on a daily basis, Damstra actually provides the hardware that you are logging in with and the card. But more importantly, it also has alcohol breathalyzer. And in more recent times, they've actually integrated essentially COVID testing at that site as well, or fever detection and temperature detection as well, which is why the stock's going on a very strong run, because they're getting unprecedented demand off the back of that. But the most important part of that is not just the recurring revenue they get off the hardware, but the information that feeds back up into their software platform, which the people managers of those businesses can understand who's on site, when they logged on, you know, notifications as to whether they've been working too long, you know, are they, you know, at what point are they working overtime and all that sort of stuff. So there's a lot of data on that. And the mining sites, obviously, this is critical information. You'd be amazed at the legacy systems they use, and sometimes, frankly, Excel spreadsheets in some of these mining sites. So they've had, you know, big customers that have signed on to their platform because they've had an accident at one of their sites and they realized they didn't actually even know who was on the site, and they saw the Damster product and literally rolled it out to every single site that they had globally. So really strong business. That business is has guided to do about $35 million of revenue for FY21, so the forward year ahead. Just to give you a sense of scale, when we invested, I think the business was doing about 15 million. Again, we were one of the largest investors in the pre-IPO and one of the cornerstones in the IPO process as well. It's, yeah, we've made, you know, probably 3 times our money on that investment. Nitro, maybe a business that some people are familiar with, also listed on the ASX. They have a document productivity software platform that they sell into large enterprises like ExxonMobil, Bank of New York Mellon, Caterpillar, and a lot of the Fortune 100 companies. Originally a Melbourne-based business that is now headquartered in San Francisco. It was founded about 15 years ago now. And this year will do roughly $40 million US in revenue. Again, this was a pre-IPO investment that we were, again, the cornerstone in the IPO. And, you know, we've made really good money on that business as well. Their core product is a platform that essentially displaces Adobe's Acrobat product. There's a whole bunch of reasons why an ExxonMobil would just take Adobe out of their entire headquarters in Houston and put Nitro in instead. And they're seeing exponential growth in this environment for the obvious reasons that, you know, in a work from home world where everyone's working remotely and people need documents signed by various people in their organization, they can do that all electronically. And there's a whole bunch of other benefits that I won't bore you with today, but for these companies to sign up. Another few other ones that are topical. Credible was a business that actually came directly to Regal as an opportunity. So I was friends with the founder of this business, and we ended up leading their pre-IPO. Again, cornerstone their IPO. This is a business that's based in the US. They have an online marketplace for. Originally, it started off out as student loans, and a place where if you had a student loan in the US, which for those that aren't aware, the student loan market in the US is larger than the Australian residential mortgage market. So a huge addressable market. And if you had a student loan, you could log onto this platform and get direct quotes from potential other potential lenders to refinance your loan at a cheaper rate. And the most slick part about this platform was that it was integrated directly into the lender's compliance and risk system. So the quotes that you would get were real time, and you could just click through, essentially click and collect, and there wasn't any people involvement in the process. Fast forward it would have been 18 to 24 months since they listed. They ultimately actually got acquired by Fox Corporation or Rupert Murdoch for 3 times what we paid for the business. You know, they saw the value in the business, and obviously Fox's angle is to push this platform across all of their other media outlets to grow the volumes through the business. I'll do a couple more. I won't go through all of them, but Whisper, again, very topical business at the moment. Again, we led the pre-IPO and led the IPO, and have been big supporters of the business since. The ticker's WSP on the ASX. It's recently gone on a very strong share price run. They are a communication software business, so think of this platform as a platform that any large enterprises or local governments or even state and federal governments can use if they want to push out messages to either their customers or their constituents, and do that in a very automated and simplified way through whatever channel you want. It can be text message, email, WhatsApp, Facebook Messenger, doesn't matter what it is. It's basically a simple way of curating what content you want to push out to your customers or your constituents. So the reason it's going on a big share price run now is it's been, one of the clients they signed up recently was the Victorian government, the health department of the Victorian government, and they are using it as their platform. So if you're in Victoria and you're getting any notifications through the COVID Safe app or through text messages from the government regarding COVID. It's all basically getting pushed through that Whisper platform. Again, that's a business that will do north of $40 million in revenue for the coming year as well. So again, big business, has a business in Asia. The Asian business is growing very fast. They're also in the US as well. And I'll do one more. QuadPay. So this is a business that's in the buy now, pay later space. This was also a proprietary deal to Regal. So Jess Farr-Jones in our team, she knew one of the founders of this business, and they came to us. They have a very similar platform to Afterpay or Zip in short form, except they were solely focused on the US. And at the time we invested, they had a very unique product which was called QuadPay Anywhere, which essentially, instead of them having to sign up a particular merchant or retailer to offer the product to their customers, if you signed onto the QuadPay platform as an individual customer, you could actually use essentially your card in your phone wallet to purchase products from any store that accepted credit card and pay still on an installment basis. And the traction they received was exceptionally strong. This has been a fantastic trade for us. And one of the key reasons why the returns in Fund 3 has been so strong. In summary, we put in about $14 million across Funds 1, 2, and 3 into this business. The bulk of that went into Fund 3 because Fund 3 had the capital available to invest at that time. That was subsequently acquired by Zip. And we had a bit of a part in that process. Regal and Phil has been close with the Zip business for a long period of time. It's been one of the largest shareholders for a long period of time. Zip needed a path to get access to the US market. And we said, look, the QuadPay business is growing really fast. Maybe this is the way that you go down that path to get access to that market. Long story short, the QuadPay business was acquired for about 2.5 or 3 times what we paid, and our consideration was 100% in shares in Zip. And subsequent to the announcement of this transaction, the Zip shares also it actually tripled at one point, but doubled as well. So the $14 million that we invested, has been worth $60 to $70 million at certain points, and we've taken the opportunity to sell down the 30% of the shares that aren't escrowed in that. So we've taken, significant profits on that trade. We still have an existing position and still like the story. And just on that one as well, it's a really good example of Regal's understanding of what the market wants and certain things happening in the market. So we were aware at the time, around this time, that the short interest in Zip was also very high for 2 reasons. The market thought that Zip was going to need to raise money, as well as the fact that Zip at that time was only an Australian business. And the reason Afterpay was performing so well was because they were a global story and their US business was flying. And so we had the view that, well, if the stock has a very heavy short interest, because that being one of the main reasons, if they do acquire QuadPay, that's going to solve that. And so that short interest is going to have to get covered. And that was one of the key reasons that the stock went on such a big rally, and we knew that going into it, and so we thought it was a good path to play.
Ben, we might. Oh, sorry, Mark.
Oh, sorry, Rob, you go, mate.
No, I was just going to say we might just give you a chance to catch your breath there. I thought perhaps as well, if you just wanted to talk through, and maybe we'll pause for some questions then, but just in terms of what we're seeing currently in that space. So you talked about, that certainly is, seeing an accelerated level of deal flow, both from a structural sense inside that into the market, but then also in a post-COVID world. Do you want to just maybe talk through the opportunity set at the moment and whether that deal flow activity continues?
Yeah, it has been, this year has been amazing in terms of the level of deal flow. I think I've said to Rob a few times, it'll have to slow down some point soon. It'll have to slow down some point soon, and it just has not. To put some numbers around it, since the peak of the COVID crisis in March, I haven't got the exact figure, but I reckon we have participated in close to 200 microcap placements since March. So the exact number was about 120 when we went out and raised the Emerging Companies Opportunities Fund, but that was 2 and a bit months ago now. and the deal flow has been very consistent since then. We are seeing about 2 deals a day. That's just the micro cap placement and IPO space. And then in addition to that, the pre-IPO space is obviously opened right up as well. So obviously, through, April to June, the pre-IPO space definitely slowed down a bit because, people were questioning whether the IPO market was going to be open and, whether there was equity available for those types of deals. But as we saw, there was a lot of microcap placements happening. Now they were happening for 2 reasons. There were a few that were in stress. Not that many though, but there were a few sort of recapitalizations that needed to happen pretty quickly. But in a lot of cases, there were businesses that actually saw exponential growth coming out of the back of it, i.e. COVID was a driver for their business and they needed to raise money just to keep up with demand. And so, there was a lot of those. And then there was others that just took advantage of the fact that the market was open to raise capital. And those trades also have done, for the most part, really well. So at the time we did the cap raise, of the 120 investments that we had made at that point in time, 8 out of 10 of them were winners, and in some case they were, significant winners. Like we made multiples on our money, and the ones that didn't trade that well, they weren't down that much. So the discounts were steep on the placements, plus you had a tailwind of a bull market coming behind you. So we did make really good money, and the deal flow just has not stopped. So to put it into context, in August is the Australian reporting season, as most people would know. So usually the bankers and the brokers stop hassling me about new deals, and I can just focus on worrying about the results of our existing portfolio companies. But during this August, I think we must have gone through 5 or 6 cornerstone processes for upcoming IPOs for this next season coming. And so there's a few coming down the pipe at the moment. And there's more IPO. Like I've got, I think, 2 more IPO meetings today. I think there's talk of, upwards of 20 to 30 IPOs happening between now and Christmas. So the deal flow has, it's been pretty hard to catch our breath, to be honest. There is so much going on. And a lot of it is at the small end of the market. So, there hasn't been that many IPOs and big cap raisers that really get the headlines. So there's obviously National Australia Bank. Sydney Airports ended up finally doing their cap raise. Cochlear was one of the first ones out of the gate. But there really hasn't been that many big placements where the big fund managers can get access to and via ECM. And I think the large part for that is the stimulus packages that the government have put out have actually been so strong that, in some cases where the companies could avoid doing a cap raise, that they actually have been able to do that. But it's the complete opposite at the small end of the market, just in terms of the sheer volume of deal flow. There is just so much coming down the pipe. And, this is a continuation. And the reason there's so much demand for these capital raises as well at the small end, it's where all the growth is. And Phil has been saying this, and, I've probably had the same conversation with Mark over the years, is, on the ASX, and, probably the same as New Zealand, there's, at the big end of town, there's just not that much growth. There's companies that are growing 5, 10%, maybe. Some are under structural pressure because they're incumbent and they're being disrupted by some of these technology businesses. Whereas in our part of the market, like a lot of our businesses are growing at, 30 to 60% their top line. They're global businesses. They're really exciting businesses. And if you want access to growth on a global stage, you basically have to come to the small end of the market because you've only got, say, WiseTech, Xero, Afterpay, 2 or 3 others that are at the big end if you want access to high growth and a global stage.
Yeah, great. Thanks, Ben. And I was just going to say, you've run us through some of these, these outstanding investments that you guys have made. Can you just also run us through a couple of the worst investments you've made, a couple of the lessons you've learned through that, the way you've worked your way through those sort of situations that you occasionally face?
Yeah, sure. So it's probably the reason, and I probably didn't speak about it as much, but the reason we've tilted the portfolio more towards listed micro caps in the pre-IPOs, is because it's what we do best. It's where we get the vast majority of deal flow. We see so much deal flow that we don't probably need to be dabbling in other stuff. And so, to be honest with you, the ones that haven't worked out are those that probably go into that what we call the expansion capital bucket. So, I made an investment in what was an earlier stage business, and it was probably, I made that maybe 3 years ago now. you know, one of those investments that it was frankly a venture capital type investment. There was an angle for we had a good connection in. There was, you know, there was obviously a good thesis behind, you know, why I invested in it. But like all early stage businesses, the software just took longer to build. The launch date kept on getting pushed out. You know, I realized too late that the CEO just wasn't delivering on his timelines, and he was promised this, and you know, I should have just acted faster than I actually did. And so that was, you know, that was an investment that, you know, essentially went to zero. It wasn't a huge investment for the firm, but it went to zero because it's an early stage business that, you know, you take on so much risk in those, and you have to be. And the other part about that one was it soaked up so much of my time because, you know, I was a large investor as a percentage of the company, but it wasn't a large investment for me. But I'd end up having to get quite involved in the business to try and work through the process and, you know, who are we going to replace this guy with and blah, 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 which frankly, you know, my time's probably better served elsewhere. And so that's one of the key reasons that we've steered away from, you know, those early stage ones. And then we had an investment in another business that was in the mining space. It was essentially a recapitalization. We bought a business, well, not the entire business, but we invested as part of a recapitalization of a business that, you know, was in insolvency, to basically get the site back up to production. And, you know, fast forward, I think 18 or 24 months, you know, the site ended up going back into administration after that. So, you know, again, probably not the core part of what we do. And that's why the focus is on, you know, we see so much deal flow in microcaps. We see so much deal flow in the pre-IPO space and really good, high quality businesses that are already got demonstrable revenue and are growing and growing. And the best ones are typically the ones where the CEO, you can tell that he's got so much on his plate. He just needs some extra capital to just go out and, you know, hire a few new sales guys to take on this opportunity, or, you know, hire a few new developers because there's so much in their suite that they want to build out because they've just got so much opportunity to go. And, you know, that's again where we've steered our focus. That also increases the liquidity of the portfolio as well. So what you would have seen over the course of from Fund 1 to Fund 2 to Fund 3, the overall percentage of the portfolio that is liquid has been far greater. Again, firstly because of the tilt towards listed microcaps, but then the turnaround cycle for our pre-IPO. So, you know, companies we invest in, they're listed within 6 to 12 months. They become then listed companies and become part of that listed portfolio as well. So, was there a second part to that question outside of just what was
No, that was good, but you have led me to think of another question, and you know, the strong relationship that you have with these businesses, and does that compromise you at all when it comes to listing? Perhaps, you know, to actually be a seller, like do those, if it's such a great IPO and it reaches a price that you think is probably too high, I mean, how are you? How do you handle those sort of situations?
Oh, look, we always, you know, I do my best to try and manage expectations of all of our companies, and just say, hey guys, I'm here to make money, and you know, at some day I'm going to be a seller, but the day that I'm going to be a seller, hopefully you're not going to be too frustrated because it's hopefully at a time when the share price is, you know, gone on a really good run. I bet, you know, I'm open with them that I'm going to have to take profits at some point. You know, and in other cases where things don't go as well, and, you know, they're probably even the easier conversations, because if things haven't panned out as we thought or as they promised, you know, we're selling for a reason, right? You know, they just haven't delivered. So it's definitely a bit of a balancing act, but we've got such a strong track record of you know, supporting businesses. So like Big Tin Can, which is one I didn't talk about in detail on that previous slide, but it's been one of the biggest winners for the firm. We've been invested in that for 4.5 years now. We've owned as much as 17% of that company at certain points. I think today we own about 10 or 11. We were cornerstone in the pre-IPO, cornerstone in the IPO. They have done, I think, 4 cap raises since they've been a listed company, and we were the cornerstone in every single one of that. So those guys love us for the obvious reason. We love them because they've delivered, the share price has gone up. You know, those conversations are very easy around, you know, if we lodge down and they see that we're selling, because, you know, we've been such big supporters. And to be honest with you, like if it wasn't for us, you know, standing by them and backing them consistently, they probably wouldn't be in the position that they are now. So look, every situation is different, but typically they love the support that we provide. We again, being able to put the Regal badge alongside their company name in the Fin review about us cornerstoning a pre-IPO and being part of an IPO, there's value to that in them for them. So yeah, no, it's typically not too much of an issue.
And Ben, maybe just around portfolio construction. So a lot of the examples you provided there obviously have, there is quite a heavy weighting towards technology type businesses, which,
Yep.
Obviously they are capital hungry and they've got huge growth opportunities ahead of them. So they do need to grow. Do you want to just give a bit of sense around, once you package up all these different opportunities, how does that look at the moment? What are you tilted towards away from other opportunities outside of, higher growth industries?
Yeah, so just from a sector standpoint, I guess we probably across the board, across the strategy in total, we probably would be, 30 to 35% technology companies, and that's been pretty consistent and on purpose. It's one of the reasons our portfolio has performed exceptionally well during 2020 because it's the new world technology has been fast forwarded 3 to 5 years, because of that. And a lot of our companies have been huge beneficiaries of that. And we as shareholders have been beneficiaries of that. So that's been a calculated bet and one that we've benefited from. The other two big sectors outside of that have been healthcare, resources, and also financial services. However, financial services, I'd say it's a bit misleading because it's actually more companies that are technology focused that just operate in the financial services space. And so you could dovetail that sort of plays into the technology side as well. But definitely, we've had some big winners in the healthcare space. A few of them have listed recently. And then on the mining side, so, we've particularly in 2020, and a lot of the deal flow, particularly in the microcap space at the moment, is on the resources side. Obviously, with interest rates where they are, everyone knows where the gold price has been tracking, and a lot of the other commodity prices have been tracking upwards pretty aggressively over the course of the last few months. So the level of opportunity in that space has been very strong. One of the biggest performers across all of the emerging companies funds has been De Grey Mining, DEG, and another associated entity called DGO. They're both listed on the ASX. Again, Gold Explorer. Let's hit a really strong deposit there. But across the board, we've been very active in the resources space. So that's how from a sector standpoint, that's how we look at it. But then also we monitor, how much we've got in, we basically break them down into, okay, there's a software businesses that are fast growth, but maybe losing money. There's software businesses that are typically fast growth again, but are already cash flow positive or cash flow neutral. Then we've got the earlier stage mining companies. We've got healthcare companies, which are split into two buckets. Again, those that are earlier stage, and then those that are generating demonstrable revenue. And then we've got a bucket of what we call the old school industrial type businesses. So we've got a bunch of businesses that we're paying 8 or 9 times PE for these businesses. They're not growing at 50%. But they might be growing their NPAT, 15 to 20%. We think that 8 to 9 times in this environment makes them cheap. We typically still want to see a catalyst event. Like, we're not just going to be invested in these, slower growth businesses for the purpose of we think it's cheap and it's, going to grow its earnings and we're going to make a 20% return off of that. We typically still want to see some form of catalyst event. And that frankly just comes back to the opportunity cost that we're always dealing with. We see so much deal flow. So it's constantly this battle of, okay, new deal coming in. We think we're going to make X on this. So, what in our existing portfolio should we reduce to make sure that we've got exposure in this other one because we think that this is going to be a better return. So, again, what we sometimes call the boring old school stocks that, trade on an 8 times PE that's growing at 15%. We still want to be, targeting a 50% return on those investments, and we want to be able to see catalyst events off the back of that as well.
Mark, we might just, pause to allow other people to ask questions. I think you're probably more familiar with the system than me, Mark, but I think that if you hover your mouse over the Q&A section, you can type in a question. So please do if anyone on the call would like to ask a question of Ben. While you're navigating that, Ben, maybe if you just want to touch perhaps on some of the risk management side, so how you think about risk. I guess liquidity risk is a big part of this strategy, and just managing portfolio risk, market risk. How do you think about I guess the downside and in terms of protecting capital?
Yeah, so again, we keep the big thing on liquidity is definitely how we size our position. So again, a lot of deal flow comes in. On the micro cap side, we know that we can swing harder at a certain transaction if we know the liquidity in the stock is quite strong, and so that is that plays into a big part of it. But we do like our system shows us essentially what the liquidity is, like how much of our portfolio it would take 100 days to reduce the exposure to, and things like that. So we've got all those metrics that we are consistently monitoring. Fortunately, over the past 6 months, the liquidity at the micro cap end of the market has been phenomenal. Again, I think that's driven by two things. It is institutional shareholders that are coming down into the small and mid cap part of the market because they need growth, and it's the only place to access growth. And then the other part is there is, without doubt, a huge wave of retail investors. I see it in the screen on a daily basis. The amount of retail, and it's very obvious that it's retail bidding, because at a certain price point there might be 200 bids on the offer, and it's that is just very clearly retail style investing. And so that has drastically improved the liquidity. So stocks that we own that might have used to trade $400,000 or $500,000 worth of shares a day, some are trading $5 to $10 million a day. So the liquidity has improved drastically, which is we've again been a huge beneficiary of, and that continues to be something we monitor. In funds 2, 3, and the opportunities fund, we do have the ability to short as well. So we do selectively take some opportunities to short. Now the key, there's a lot of risk in shorting microcap stories, because as we've seen, some of these stories can go on some pretty astronomical runs, and so you really can't get caught on the wrong side of those. Fortunately, we haven't. Typically the ones that we're looking to have a short position in is ones that we see that it's pretty obvious to us that the company is going to need to raise money over a 3 or 6 month period. And typically what you see is that once the market starts to realize that, the share price starts to drift away, and then, we look to then cover our short positions in via the placement of that capital raise. And so we've had a couple of successful stories where we've done that. They're probably the key elements on it from a risk. I mean, the liquidity one's the big one. And again, we've tilted the portfolio much more heavily towards, and fortunately, a lot of our companies, because they've gone from 100 to 200 mil market caps to now a lot of them 400, 500 mil market caps, that just brings liquidity. And it's probably a good point on for us of, what I love to say is, I love it when these stories graduate through the Regal empire. Obviously, the fund that Jess and I manage is at the smaller end. But what we want to see is these companies grow and end up being investments in the small companies fund, being investments in Phil's bigger funds, because it means the company is, essentially grown into the big part of the market, and it's open to a broader universe. And we can, the benefit that we've had on knowing these stocks intimately for maybe 1 or 2 years before they get to that stage, we can pass all of that on to other people in the firm if they want to invest. So, and just to be clear on that, we can hold the positions in our fund as long as we want. So we don't just, once it gets past 300 mil market cap, just transfer it to other funds at Regal. A lot of the businesses, some of the biggest investments that we still hold in our fund now, like Nitro, Life 360, Big Tin Can, they're now $500-600 million companies, but they're still held in our fund because we're allowed to hold them for as long as we want.
We've got a few questions come through, Ben. So this one is a very good question. What are the critical things to look for when you're carrying out DD on a company?
So the biggest thing for us is management. So at the big end of town, you have layers and layers of management under a CEO. So the CEO is obviously clearly very important at, whether it's Wesfarmers or, whatever big company. But, there's always a significant number of layers of management underneath that, mitigates that risk because it's such a big organization. You just don't have that typically at the small end. The CEOs of a lot of our business are the founders or the entrepreneurs that started the business. They know the business intimately. In a lot of cases, they've got a and one of the key things for us is the CFO as well. So we love it when we see a CEO/founder of a business who's running the business, who understands the tech and is really good on the sales side in a lot of cases. But we want them to be, it's very rare that you get a guy or a girl who's very good at that, but then also perfect on every aspect of the financials as well. You typically want to see a CFO. In a lot of cases, we make it as part of our transaction that you need to hire a CFO, a very turbocharged CFO, within a short period of time. Most of the businesses we're dealing in now, they've already got a very strong finance function, so it doesn't happen as much these days. But the long story short, the management team, having trust in these management teams and their ability to deliver is by far the most critical thing at the small end of the market. Just because, you know, these people, you know, live and breathe this business, and it sort of hangs on their hat. The other thing we look for is, you know, we prefer a global business, just because Australia and New Zealand's just pretty small. And so if these businesses are selling into a global addressable market, then the opportunity set is just significantly bigger. That's why we liked Nitro, Damstra, Big Tin Can, these sorts of businesses that have got huge addressable markets to go after. And then there's all the standard, you know, key financial metrics. So in the software space, we want to see really strong, what we call net revenue retention, which is basically a simple way of saying we want to see that you can grow your business from your existing customer base. So a lot of these software businesses, they might sell to, you know, Nitro is a great example. You know, they might sell into the Boston headquarters of a certain organization, and that's, you know, 5,000 out of their 50,000 global workforce. But if they can then roll out that platform across the entire workforce globally, then there's a huge runway for growth just within their existing customer base. And so, you know, the way that the market looks at that is on a net revenue retention basis. And so, you know, Nitro, for example, it's 120%. So you can almost say that next year that business is going to grow it by 20%, even if they don't sign a new customer. And so every new customer on top of that just adds to that growth rate. So that's a key metric. And then the other key metric, which again, a lot of people look at, is the lifetime value of the customer base of the businesses, and how that compares to how much they're essentially paying for their customers. So their CAC, or their customer acquisition costs. So they're, you know, I could go on about a whole bunch of different metrics, but they're two very critical metrics that we look at. And then we take a bit of a market lens as well as to what are the stage gates and what are the catalysts that these companies are going to go through over the course of, you know, the next 12 to 24 months, which are going to cause us the share price to re-rate. And they're things like, we might be investing in a business that it's got a market value of, say, $80 million. But we know that once they get through 100, and particularly when they get through a $200 million market cap, the universe of investors just increases dramatically. The liquidity increases dramatically. All of those things cause share prices to rally as well. So, you know, in the interest of time, just one last thing on that as well is just structuring the deal. So sometimes we do deals in equity, where we're taking fixed price risk. This is on the unlisted side, obviously, fixed price risk that we think we're going to make money into the IPO. But a lot of the transactions we structure as convertible notes. So they convert into the IPO at a fixed discount to the IPO price. And in a lot of cases, we negotiate a cap as well. So if the IPO ends up happening at $2 and we negotiate a cap of $1, then we still double our money into the IPO, as opposed to just making the sort of 20-25% into that IPO. And we do equity versus debt, depending on the risk profile of that investment as well. So there's a lot of thought that goes into each transaction, how we best structure it. Sorry, I'll try and be quick on the next question so that we can get through.
There is one other, well, there are a couple others, but we can actually answer some of these subsequent. But let's give you one more. What is the future of IPOs? Do you see SPACs or direct listings coming to the Australian market?
I don't see SPACs coming to Australia. The Australian market's just, you know, Australian investors typically want to know what they're investing in, as opposed to essentially giving, you know, a fair bit of capital over to someone and entrusting them with it. And I think the NASDAQ is such a beast in terms of trying to get listed. It is a massive process, and the compliance around it is huge and whatever. So the reason for the SPACs to come about is to try and ease and make that process slightly easier. Whereas the ASX, the process to get listed, whilst it's still quite, you know, intensive and it takes a lot of time and a lot of lawyers and a lot of accountants. It's a much easier process than it is on the NASDAQ. And so, you know, I don't see SPACs coming to Australia. I think people will just list the businesses that they're, and, you know, Australian investors prefer investing in businesses that they know what they're investing in, as opposed to flying a bit blind, I guess.
Excellent. All right. Well, look, I think we're just about out of time. So for all of you who've dialed in, thank you very much. If you have questions or any follow-up questions, please send them through and get in touch with us. Just to wind it up, I'd just like to sort of say how we at SACS see this. I mean, this is we think, a great opportunity for New Zealand investors. And yet it sits outside, I think, what many people would consider to be part of a typical portfolio. And a lot of people perhaps think it would be a very risky investment to make. But we actually look at risk from two perspectives. We look at risk from the perspective of, you know, what is the chance of us losing our capital? And then the second thing we look at is, you know, what is the chance of us achieving the return that we expect to achieve in this strategy? And that really boils down to our confidence in the manager, our confidence in their position, in their track record, in their expertise. And in this case, we think that if you take a 5-year view on this investment, it is very unlikely, given the due diligence that Regal applied, given the diversification they achieve in their portfolio, given the strength of the underlying market. It's very unlikely, I think, that we're going to lose our money. We may not do as well as we expected, but then I think there's a very high likelihood that we will do as well as what we've expected to do. And in the last 4 or 5 years, we at SACS have participated in all 4 of these funds, and we have achieved returns in line and above our expectations. So those are the risks that we think about. And at the end of the day, I'm a great believer in Warren Buffett's comments on risk. And as he says, risk is not knowing what you're doing. And I think that is the way we see it. So we're delighted to have you, Rob and Ben. Thank you so much for your time. And we appreciate the work you do for us and for our clients. And so any of you out there would like to talk further about this and other funds that we allocate capital to, then please get in touch with us. And if you'd like a copy of this webinar, also just fire us an email and we'll send you the link. Thanks a lot, guys. Appreciate it.
Guys, appreciate the support.
Everyone.
Appreciate the time.
Thanks very much. See you all later.